Hello, good evening. How are you guys?
Good evening, sir.
So, how's the things going? Okay, if I'm not wrong, two students from you submitted your work, and one was actually busy. I got the message as well, and Miss Divya was busy, I guess. Miss Davina, did you send me your homework? Miss Nabila did happen to send me her homework. I checked her homework as well. Who's the other one who sent me the homework? Actually, I can't see the name over here. Okay, Miss Anshutra is saying she sent me the work. Okay. Okay, Miss Davina is saying, yeah, Miss Anshutra, you. How are you feeling now? And how you got electrocuted, by the way? How are you feeling now? Oh, so I hope you are well now and do take care of yourself. I mean, this is very something really very dangerous, and I hope you are well now. Okay, Ms. Davina, you are saying your question did not balance. So for next time, if I give you some homework or something, even if the answer is incorrect or something, or even if you are not able to get your balances correct and all, at least send me the homework so that I can get an idea where you guys are actually standing and why or what problem is there in the question, so that I can pinpoint it to you where you are actually having a mistake, so that if I tell you the mistake individually, by identifying, so that you will have a better understanding and better idea that how to correct it and what was the mistake actually you had done, so that for the next time you won't be having the same mistake again. Okay, so even if your answers not match or something, at least send me the work so that I can get an idea that how you performed your work or how you did your workings, so that if there is any ambiguity at your end, I can say, or if any unclarity about what to do or how to do, I can guide you all about that. Okay, so today we will be moving forward, and as far as my understanding is concerned, based on the homework that I gave and also the questions that we did in the class as well, your T accounts understanding is developing now, right? Your understanding for the T accounts is kind of developing now, and we can move forward towards as far as the trial balance itself is concerned. Because today, I want to discuss with you the basic format for the financial statements. And after discussing the basic format, we will be doing a bit of some other basic topics as well from the accounting, so as to get an idea basically how the accounting as a whole works and what those little topics have to do. But before going towards that, I have to discuss the final accounts or the structure of the financial statements basically with you, so that whenever I am into my later topics talking about you, that if a certain entry is going to have an effect in the statement of comprehensive income or in the statement of financial position, at least at that time, you do get an idea that what I am talking about and where in the financial statements that thing has to adjust, right? This is what, my basic approach for today's lecture is basically related to. So, without wasting any time, let's just start and let's just have a discussion about the stuff that we are going to have. Over here, we are going to have a business name, and then we are going to have statement of comprehensive income for the period ended date. Okay, this date and this period has to be highlighted for now. And then we are going to have a currency sign here and a currency sign here as well. Okay, before moving ahead, I just wrote a term business over here. Talking about the business, a business is any activity carried out with the intention to create profit. What's a business? Business is any activity carried out with the intention to create profit. Whatever you do, but at the end of the day, your intention is to get the profit. So that activity is going to be classified, or that activity is going to be called as a business. First thing. Secondly, when talking about the types of the business, we have a sole trader, we have a partnership, and then we have a company. We have three types of the business. One is the sole trader, one is the partnership, and one is a company. Sole trader is, I call it as a one-man show, because a single owner working or carrying out the activity to create profit. That is what a sole trader is. Talking about a partnership where more than one, but maximum 20 members working together in an activity to create profit, is known as a partnership, where there are more than one owner of the business, and the maximum owners in a business which can be there in a partnership is 20. And then we have a company where we have infinite number of shareholders or owners, where there are number of, people who have invested into the business, and that number can be any, from ranging from two to like millions or trillions. There can be shareholders as well, and they are the one who have invested in the business. And normally the management and the owners, as far as a company is concerned, they can vary, and it's not necessary for a company to have the same owner and the same management. Basically, the management is different than the shareholders basically in the company. But as far as the sole traders are concerned, or as far as the partnership are concerned, normally the management and the owners are the same. For now, today, discussing about the format of the financial statements, we will be discussing about the formats of a sole trader. We will be discussing about the format of a sole trader. So the accounts which I'm going to make for now are basically of a sole trader. Done. As far as the company accounts are concerned, or the partnership, or even the sole traders are concerned, more or less the picture is same, apart from the capital area and apart from a bit of a presentation as far as in the statement of comprehensive income is concerned. Uh, 60 to 70% of the format is same. Rest 20 to 30% is a bit different. Okay, so this is what we are going to have. So in the top we have the sales revenue, then we less sales return, and wait a second. Okay, then when we net off the sales return from the sales revenue, we get net sales. Then we less cost of sales from it, and the cost of sales is opening inventory plus purchases. Okay, we have to do it a bit. Okay, minus closing inventory. So we have this opening inventory, then we have the purchases, then we have less purchase return as well, and then we have less closing inventory. So we get this cost of sales, and then from this we get our gross profit. Hold on for a second, please. Okay, after the gross profit, now this is the first difference that we are going to have in the accounts of the sole trader and the company as well. And talking about this sole trader thingy, we are going to have number of expenses over here, and those expenses are explicitly mentioned over here. For example, we have to less, for example, heat and light, we have repair and maintenance, we have um, heat and light, repair and maintenance, then we can have wages and salaries. Apart from the wages and salaries, we can have some traveling expense, we can have some heat and light, repair and maintenance, wages and salaries, traveling expense. I mean, any expense whatsoever that you have, it will appear right over here. Okay, so these are the expenses that we have. Then we are going to have the total of these outside in the outer column, and then we will have any other income whatsoever. If it is over there, we will have it here, and then we are going to have this profit before tax over here. Then we are going to have our tax expense, and then we are going to have our profit for the period over here. Okay, so this is the profit for the period over here at the end of the day that we have over here, and this is what the accounts of a sole trader that we have, which is kind of related to this, uh, like format like this. Then moving ahead from here, after this, we have this statement of financial position now. We are going to have the business name over here, and then we are going to have a statement of financial position as at, and then we have the date with us. As far as this business name is concerned, this is again going to be into the center. This statement of financial position is going to be on the left line basically. And then as far as this date is concerned, I am highlighting this date over here. Then we have the currency signs, and then we have the heading of assets. And as far as the assets are concerned, we are going to have, first of all, non-current assets. And in the non-current assets, we are going to have land and building, plant and machinery, motor vehicles. Okay, then we will have their total in the outer column. And then we are going to have the current assets with us. As far as the current assets are concerned, we are going to have inventory, receivables, cash at bank, cash in hand. So these are the current assets that we are going to have here. Then we are going to have their total in the outer column, and then we are going to have the total assets over here. Okay, then we are going to have capital and liabilities. As far as the capital and liabilities are concerned, we are going to have the capital. Then we are going to add profit for the period. And then we are going to less the drawings from it. Okay. And we are going to have the total in the outer column, and then we are going to have non-current liabilities. Say in case we have any loan or something over here, it is going to be reported over here, or it is going to appear over here. And this will go into the outer column, and then we have the current liabilities. And in the current liabilities, we are going to have the payables. We can have a bank overdraft as well. We can have an interest payable or whatsoever stuff like this. The total is going to be reported in the order column. And then we are going to have total capital and liabilities. Okay. So this is the basic format for as far as the statement of financial position is concerned. So this is the basic format that we have for the statement of comprehensive income and the statement of financial position. And as far as the sole traders are concerned, the differences are going to be into this section, the capital one, and this section as well. And as far as the breakup of the cost of sales is concerned, we have the difference of this as well. I mean, as when compared with the company accounts, because in company accounts, normally the cost of sales is represented as a one single item or one single line item. Basically, we don't show the breakup of the cost of sales onto the face of this statement of comprehensive income. And we have a reference for that. In that reference, basically, we give the working, that what was the opening inventory, what were the purchase during the period, what were any other expenses whatsoever related to the cost of sales, basically, in that period. And as far as the expenses are concerned, we have the two major heads in the company accounts. One is the administrative expense, and one is the selling and distribution, basically. And we bifurcate the expenses according into those two major heads. But as far as the sole trader is concerned, we keep on, representing, or we keep on presenting the expenses on the face of the statement of comprehensive income. The reason being, basically, we have to give an idea to our user, and that is the sole trader, obviously, that what he has spent as far as in the name of the expenses is concerned. And then this, as far as the capital is concerned, for the sole trader, it is capital. For the partnership, it is the partner's capital. And for the company, this is the equity that we have over here. And obviously, again, the workings relating to the partner's capital or the equity in the context of the company, they have their own variations regarding what to do and how to do. And then moving ahead from here, talking about these financial statements, obviously, whatever we do, it has a use. And talking about the statement of comprehensive income, it actually tells us about the performance of the business, that at the end of the day, what we have earned, what we have lost, what was our profit, what was our expenses, what was our income, basically. This is what the information being given from the statement of comprehensive income is, that it tells about the overall performance of the business at the end of the day. This is what the role of the statement of comprehensive income is. And then talking about the statement of financial position. Statement of financial position, basically, as the name suggests, financial position, it gives us the idea about the financial standing of the business at any given point of time, right? At any given point of time, it tells us about the financial viability, financial worth, or the financial stability of the business. Now, there is an inherent limitation, by default limitation, of the financial statements, and that is they give us the idea about the past. They give us the idea about the past. I mean, if you look over here, we have written the statement of comprehensive income for the period ended. It tells us about the performance of the company, performance of the business at the end of time, right? At the end of the day, at the end of the week, at the end of the month, at the end of the quarter, at the end of the year. But it always tells us the information when the time has passed. It does not gives us the information as and when the time is running. I mean, we can prepare, but again, the information which is provided is again going to be at the end of that particular time. This is the inherent limitation. While conducting a transaction, it is not going to tell us either we are going to be profitable or we are going to be into a loss or something. It tells after the time has ended or so. So, this is what the basic inherent limitation of the financial statements is. Similarly, talking about the statement of financial position, it gives us the position of the financial viability of the business at a specific time. I mean, we can do a projection regarding the future performance, regarding the future results. We can do a projection on the basis of the financial statements that we have, but we or these financial statements cannot guarantee the future performance. It cannot guarantee. It can give an idea. It can give a hint. It can anticipate. but it cannot guarantee, right? It cannot guarantee about what will be done in the future. It cannot guarantee you about that. Done. So this is going to be the inherent limitation as far as for the business is concerned. Done. Now talking about this, let's just have a look at an example for a trial balance. Let's just say this is Mr. A, a sole trader. Then we have a trial balance for the year ended 31st December 20x2. Let's just have, and this is the debit column, this is the credit column, and then we have cash at bank, we have motor vehicles, we have sales, we have opening inventory, we have heat and light, we have receivables, we have payables, we have loan, we have capital, we have cash in hand, we have purchases, we have traveling expense, we have let's just say sales or return, we have land and building, we have drawings. Similarly, we have purchase return. We have, apart from the heat and light, let's just say we have repair and maintenance. And we'll see about a one or two over here. And then we are going to have our column for the sake of this. And then we are going to have the sum over here. Now, let's just say we have a cash at bank of 4,500. We have the motor vehicles for of 1,000. This motor vehicle should be 135, no 1,000. 44,500 over here. Have heat and light of 90,000. We have receivables of 500,000. We have a loan of and of 69,000. Then we did the purchases of 1250000. Then we had the traveling expenses of 60,000. Then we had sales return of 150,000. Then we have a land and building of 950,000. Then we did the drawings of like 290,000. Then we did purchase a return. Purchase return is for 80,000. Then we had the repair and maintenance account, and 60,000. just have the loan for 1200,000 for now. Let's have the capital of let's find the figure of capital for now. So the capital 121,850. Okay. And we will be having an additional information that closing inventory for the year is 350,000. Done. Now look here how the things are going to work. I am going to clear these up. Okay. No fail. Okay, first of all, where the business name is written, we are going to write Mr. A. Then this period is going to be year ended 31st December 20x2. Similarly, we are going to have Mr. A as at this date is going to be 31st December 20x2. Okay. Okay. Now let's just start. First of all, we have cash at bank. So this cash at bank is at 44,500. Then we have motor vehicles, which are standing at 335,000. Then we have sales of 1650. Then we have opening inventory of 300,000. Then we have heat and light of 90,000. Then we have receivables of 500,000. Then we have payables of 350,000. Then we have loan of 800,000. Then we have capital of 1218. 500. Then we have cash in hand of 69,000. Then we have purchase of 1250. Then we have traveling expense of 60,000. Then we have purchases of 1250, traveling expense 60,000. Then we have sales return of 150,000. Then we have land and building of 950,000. Then we have drawings of 290,000. And we have purchase return of 80,000 over here. Then we have repair of 60,000. And it will go into the inventory at 350,000. What I did over here, remember the questions, question 4 and 6 you had to solve from the transactions, and then you did the double entry, then you made up the TA accounts, and after the TA accounts, you prepared a trial balance, right? Remember our exercise that we did? I have done the same things, that by assuming these are the balances now in the trial balance of Mr. A's some business, and after balancing of the accounts and all, now these are the balances that I have. We read about the definition of the accounting, that it is the recording, summarizing, presentation, and presentation of financial transactions. As far as the recording is concerned, we did the accounting question, we did the double entry. As far as for the summarizing stage is concerned, we did the T accounts and then balance them off. And now from summarizing to the presentation stage, we had a bridge, and that is the trial balance. And now we are on to the presentation stage, in which we have these financial statements with us, which we are preparing for now. So this is the working for the presentation area now, where we are preparing our financial statements. And obviously we need to have a trial balance from which we are going to prepare our financial statements. So I had this trial balance. I've put in the figures now, and now let's just do the working for these. We have, as far as these figures are concerned, and we are going to have the sum of the sales and cost of sales. We get 380,000 as our gross profit. Then we have the sum of these are 210. We don't have any other income or whatsoever. And the profit before tax is the sum of these. We don't have any tax expense for now, so the profit for the period is basically 170,000. This is profit for the year now. And this profit for the period is the same, the profit for the year, which is going to be reported over here at 170,000. We don't have any plant and machinery over here. I've just given you the idea. Whatever the assets we have, we are going to write them. So we are going to have the sum of these two. Then we are going to have the sum of these four. Then we are going to have the sum of these current and the non-current assets. So we have the total assets of 2.24 million. So now we have the sum of this capital. Then we have this, and now we have only the payables in our liabilities, no bank overdraft, no interest payable whatsoever. Now we are going to have the total of these. So this is again 2248500. That is equal to this total assets. Remember the accounting equation we read, that the total assets is equal to capital plus liabilities. Line statement now. So what I did from the horizontal, I just switched it to the vertical, and now still the concept is saying that the total assets is equal to total of capital and liabilities. Total assets is equal to capital and liabilities. So the accounting question has now stretched into the statement of financial position. So this is what the concept is, or this is what basically the idea is behind the financial statements which we just discussed, or the way or the approach by how the financial statements are prepared for the, as far as the business of the sole trader is concerned. Let's just have a break of only maximum 2 to 3 minutes. I just need a break of 2 3 minutes, and then we are going to resume and we are going to start off with another topic now. Let's just have a break, only maximum 2 3 minutes. Okay, I'm back. So after these financial statements, let's just have a discussion about a bit of a basic topic, rather, I would say, not a big some topic, but that topic is only used for the sake of understanding. And that topic is called as discounts. Talking about discounts, that is decrease in of value. As far as the types of discounts from the accounting point of view is concerned, one is called trade discount, one is called settlement or cash discount. One is the trade discount and one is called as the cash discount or settlement discount. Talking about the trade discount, we also call it bulk discount. We call it as bargain discount as well. And this is something the discount available because of the nature of trade. The discount available because of the nature of trade is called as a trade discount. That is called as a trade discount. The discount available because of the nature of trade, or the discount that negotiations, bargaining skills or something, that is called as a trade discount. For example, let's just have a basic example for this, that you go to a mall for a shopping or something, and you decide to get yourself a pair of shoes, right? You decide to get a pair of shoes for yourself, and saying case that pair of shoe is for like $150. Now, mostly at shops, we see that the prices are fixed. Let's just say for now that over there on that shop, you can do a bargain with the shopkeeper. And you start off bargaining that I cannot pay 150, and what can be the discount for me and all. And you start off with the stuff, and you say that I can get this for for $120. You end up getting the shoes for $120. Even though the shoe cost $150, okay, I'm sorry, I got disconnected. Okay, so the price of the shoe was basically at $150, but you end up getting the shoes for $120. So $30 is basically your discount, right? Now, how this is going to be recorded in your account? As far as the recording is concerned, you are going to debit the shoes for 120, and then you are going to credit the cash for 120. As far as getting the discount is concerned, this bargaining discount is concerned, this trade discount is concerned, we do not record the trade discount. We do not record the trade discount. The nature or the reason being because the transaction has triggered after the discount. The transaction has triggered after the discount, right? The transaction is after the discount. Going to record the trade discount in your books. You are going to record the trade discount in your books because your I'm sorry, got disconnected again. Okay, it won't happen again. Now I've connected my 4G. So I was saying that the thing which is to be remembered over here is that the trade discount is never ever going to be recorded in the books because the transaction is triggered or the transaction has occurred after taking into account the discount is concerned. Now, for example, you are into the market and you enter a shop for to get something or whatever you want to buy, and over there there is a flat sale of like around 20, 30, or 40% or something, right? So if there is a sale in the shop or in the the area or in the mall or in the outlet, wherever you go, whatever the list price is there, you are going to get a discount on that, right? Even in that case as well, the discount that you are getting that on the spot, and the transaction is triggering after taking into account the discount is concerned. For example, if it's 30% off and the thing is for like around $100 or something, so $100 minus the 30%, that is the $30. The net amount is the $70 on which the transaction is triggering. So the point to be remembered over here is the trade discount is never ever going to be recorded in your books. You are not supposed to record the trade discount in your books. Done. Then comes the settlement or cash discount. Then comes the settlement or the cash discount. The discount available or given by the seller to buyer for early payment. The discount available or given by the seller to the buyer for early payment is called as the settlement discount or is called as the cash discount. And this is a discount which is available from the seller to the buyer because the seller wants to get the cash earlier. So that is why the seller is offering offering a discount that is called as a settlement discount, or that is called as a cash discount. And one thing again which is to be remembered over here is that this is the discount which is going to be recorded in the books. For example, you bought the shoes, debit 120 with the shoes, and for example, rather than buying the cash, you bought them on credit. So creditor, or let's just say shopkeeper, gave you a discount of 120. Now the shopkeeper gave you a credit period of 10 days. The shopkeeper gave you a credit period of 10 days. So if you do the payment after 10 days, what entry you are going to do in your books is you are going to debit the shopkeeper with 120, and then you are going to credit the cash with 120. This is the entry that you are going to do at the end of the credit period when you settle up the accounts. However, there can be a possibility that the shopkeeper gives you or allows you a discount by saying that the credit period is for 10 days, but if the payment is made within 3 days, you will get a discount of 5%. But if the payment is made within 3 days, you will get a discount of 5%. So now what the shopkeeper is doing, in order to get the early payment from you, the shopkeeper is allowing you another 5% discount. And if you do the payment within 3 days, you will be eligible for this 5% discount. Otherwise, you won't be eligible for this discount. Then, if you do the payment early, only then you will be eligible for this discount. Otherwise, you won't be eligible for this discount. Now, let's just assume you don't take up this discount. Let's just assume you don't take up this discount. You do either payment on the 5th, 6th, or even after the 10 days. Then this actual entry will be done in your books. Done? Now, if you decide to take up the discount, now what will happen? If you decide to take up the discount, now what will happen? The things are again going to be simple, and that is how you are going to debit the 120. You are going to credit the cash with 114, because you are going to get a discount of 5%, that is 120 dollar. 120 into 5% is $6. So technically now you are having a discount of $6. So you had to pay $120 to the shopkeeper, but now you are only going to pay $114 because you got or you availed a discount of 5%. Now what will happen? You are going to credit this discount, receive 06 as your income. As your income, it will be recorded in your accounts. Done? So this is going to be discount receive, and this is going to be recorded as your income because you availed the discount. And talking about the books of shopkeeper, now he has sold the goods to you, or he has sold his shoes to you. What he is going to do, the double entry now, is he is going to debit you with 120, and then he is going to credit the sales with 120. Done. If he has received the payment after 10 days, if the received after 10 days, then debit cash 120 and credit you with 120. You means the customer. We are the customers, huh? So he's just going to pass this simple double entry. But if the payment is received after 3 days, while you availing a discount of 5%, then you are availing a discount of 5%. So what will happen? Debit you with 120 because your total balance is at 120, which is going to be cleared, and he will be crediting the cash with 114 because you have availed a discount of $6. And now he is going to debit discount allowed with 0.6. So this is how he is going to record this discount allowed over here. So for him, this is discount allowed, and for you, this is the discount received that has been called as the income. For him, this is an expense. So the things to remember here, or the things that we have to keep in our mind, is discount allowed is an expense, discount received is an income. Done. And discount allowed is an expense. You being the, we are talking about from the accounting point of view now, from the business point of view now, that if we allow a discount to a customer, then obviously the discount allowed is an expense and discount received is an income. And no matter whatever the discount is, i.e., it's either discount allowed or it's discount received, it will not be recorded. Sorry, it will not be recorded. No matter whatever the discount is, it's either discount allowed or discount received. It will not have any effect on the purchase or sales. No matter whatever the discount is, it's not going to affect the purchases, it's not going to affect the sales as well. The amount of the purchase, the amount of the sale is going to remain the same. It will not be affected by this. The discount allowed decrease the receivables, discount received decreases the payables. Discount allowed decreases the receivables, discount received decreases the payables. This is what you have to remember as well, apart from the discounts, that the discount allowed basically hits or it decreases our receivables or our debtors, and discount received basically decreases or it hits our payables. Then this is the two things that we have to keep it in mind. Okay, so discount allowed is an expense and discount received is an income. Done. Moving ahead now from here, the concept of the discount is simple, that you have to keep in mind that discount allowed is an expense and discount received is an income. And talking about whenever if we have the discount allowed or discount received in our books, the simple as far as the place that they go is the statement of comprehensive income. And let me show you now. This is the statement of comprehensive income. Remember, this is the other income where I did not happen to write anything. other income, we can have the discount receive over here. We can have the discount receive over here. We will write the discount receive over here, and it will be netted off from these expense, and we'll have a net effect outside. And if we have a discount allowed or something, it will come over here as well. If we have a discount allowed, it is going to enter here, and then we will have a discount allowed as well, which will be written here. Done. We will have a discount allowed, which we will write into the head of the expenses. So if we have a discount allowed, it will be deducted in the statement of comprehensive income. If we have a discount received, it will be added in the statement of comprehensive income. This is what the rule is. This is what you have to keep in your mind. Okay. I hope it's clear to you guys. Okay, moving back. This was the concept related to the discounts. Done. And just give me a second now. I have to uh, check. I guess I have a bit of few small questions related to this discount. And as we are into the phase of discussing these discounts and all, let me check if I have them somewhere near me. Okay, I don't have these questions. Basically, these are of the tasks which we are supposed to start right now. Okay, we'll see about the questions a bit later, like around 10-15 minutes afterwards. Then we are going to start off with these. Okay. So we were talking about the discounts. This is done. Moving ahead from here. Now we have another topic with us, and that is going to be called as sales tax. These are smaller topics, or very small little topics that we have to discuss, because these are going to build up our basis for now. And talking about this sales tax, basically, sales tax is a form of, let's just write, okay, I was talking about the tax. Sales tax is a form of indirect taxation, and whatever we buy in the market, basically, we have to pay a tax on it. For example, if you even if you buy a water bottle in the market, and if you try to zoom it, on the bottle, if the price is printed on it, you can see whatever the MRPS, and afterwards the amount is written plus ST, and then again a single amount is written, and then afterwards we have a total amount that we have to pay. For example, talking about over here in Pakistan, I mean, if I buy a half-liter bottle of water, if I buy a half-liter water bottle, it's written on the bottle MRPS rupees. I guess that is, I don't exactly remember the water price. 22.15 plus ST 2.85 is equal to MRPS, that is 25. This is how it is printed on the water bottle. Now look here. This MRPS 22.15 is basically the actual amount or actual price of the water bottle. And then we are paying a tax or sales tax of 2.85 on that bottle, and then we are eventually paying a total amount of 25 rupees. Done. So this is what a basic example of the tax that I have given to you. Similarly, whatever you think you buy, you are going to pay a tax on that, the product basically that you are getting. Done. So this is what basically the concept is. Hold on for a second. I mean, I have this tissue box with me, and this is again RPS 128.ST, and then I have a sales tax figure over here as well. I mean, if it is visible to you. So this is a basic thing which I'm showing you guys, that whatever you buy, eventually you have to pay the sales tax on that particular thing. And one thing which you have to keep in your mind is sales tax is eventually borne by the end user. It is the end user who has to bear the sales tax. Okay, this is the end user who has to bear the sales tax. And then talking about the sales tax, one thing is really very interesting. One thing is really very interesting, and that is the business that is registered for sales tax is essentially a collecting or a collection agent for the government. The business that is registered for the tax is a collecting agent or a collection agent for the government. Basically, sales tax is the earning of the government, and rather than the government representatives moving here and there to collect the tax, they give, or the tax authority gives the responsibility to the businesses who are registered for the tax, that they have to deduct the tax, and then they have to submit the tax deducted from the customers to the government. Done. And this is what basically you have to do. And talking about this, sales tax is charged on purchases is called input tax, and charged on sales is output tax. Because obviously, as far as from the business point of view is concerned, we have to input the goods and then we have to do the output. Now, when we are buying, basically we are giving an input into the business, and then we are selling, we are doing an output of the business, or we are showing the uh, as far as the overall, when we are selling, we are charging to the customer. So when we are buying, eventually we are the one who are basically paying the tax. And then again, uh, talking about, we from the business point of view, we calculate a one single net amount that is either receivable or that is either payable to the government at the end of the day. For example, let's just say that we bought goods for 10,000 excluding tax. Rate of sales tax is 10%. What will be the double entry to record this transaction? We bought goods for $10,000 excluding tax, and the amount of the tax is 10% over here. What will be the double entry to record this transaction? If there was no tax, simple entry would have been debit purchase 10,000, credit payable with 10,000. If there was no tax, the simple double entry would have been debit purchase with 10,000, credit the payables with the 10,000. And now with tax, we are going to debit the purchases with 10,000, no change. Then we are going to debit the tax that we have to pay, and that is going to be 10,000. 10% we have 1,000, and then we are going to credit the payable with 11,000. Now this tax that we have paid, we can call it input tax. We can call it as tax refundable as well. We can call it input tax, we can call it as the refundable tax as well, because if we are registered for the sales tax purposes and if we are paying the tax, that tax is eventually going to be refunded from the government. Now, I said a very interesting statement that if we are registered for the tax purposes and we are paying the tax, if we are registered for the tax purposes and we are paying the tax, and we being the business, if we buy anything and we pay the tax on that, that tax is refundable from the government. Now, earlier I said that sales tax is eventually borne by the end user, not end user. Now I'm saying that the tax which we have paid is going to be refunded from the government. Why is that? Because the goods that we have bought, we are eventually going to sell them as well to the end user. Nah? We are not the end user. We are the intermediary, party into it, because we have bought our inputs and then we are going to sell it, and then we are going to charge the tax to the customers. So we are not the end user. Now, the interesting thing which you have to note over here as well is this purchase and then this payable. They have a very interesting situation over here. Okay. This purchase is always net of tax, and this is always gross of tax. Now, these are the two interesting things which I've written over here. The purchases are always net of tax, and the payables are always gross of tax. Now, what's this? The purchase which we write in the accounts or which we record in our accounts basically represent our expenses that we have done as far as in order for the resale purposes and all is concerned. Whatever we do for the resale purposes or whatever we buy for the sake of the resale purposes is basically are being called as our expenses, and we are going to record them as our purchases, right? So that is an expense for the business. But this tax is not recorded into the purchase. Why? Because this tax, this input tax, this refundable tax is eventually going to be refunded from the government. Sooner or later, like today, tomorrow, day after tomorrow, after a week, or after maximum month, that amount is eventually going to be refunded from the government. So if that amount is going to be refunded from the government and that amount is basically our asset, so then why to write it as an expense? I mean, if something is refundable, we are going to receive it, and that is going to be called as an asset, right? So what's the point of recording the asset as an expense if it's refundable, right? If it's refundable, so why to record it as an as an expense? So why to record it, or why to add it up into the purchases? So that is why we record the purchases net of tax. Now a question comes in mind: what if the tax is not refundable? I mean, we have done some purchases and know that the tax is not refundable. Or say in case we are not registered for the tax purposes, then what? I mean, even if we are not registered for the tax purposes, we will eventually have to pay the tax to the party from which we are buying, right? So if we are not registered for the tax purposes and we are buying from the party who in actually is, then in that case, what will happen? In that case, we will be recording the purchases at 11,000 and payables at 11,000. We won't be recording the refundable tax 1,000 separately because now our expense is 11,000. This 1,000 paid in the name of the tax is not refundable to us. So this is going to be our expense. Then only you are going to record the tax in the purchase if it's non-refundable. And look here, the payables, they are always recorded as gross of tax. They are always recorded including tax. We always record the payables with the full amount, that is including the tax as well. Why? Because you guys tell me, when you go to the market to buy something, I mean, I just gave you the two examples of the water bottle and the tissue paper box as well. I mean, when you go to the market to buy something, even you do, when you go to do some grocery or something, when you pay to the shopkeeper, you don't pay like this. Okay, here you go, 22 rupees for your water bottle and this 3 rupees for your tax. You don't pay like this. You pay like this is the 25 rupees for your water bottle, right? This is what you do now. You don't bifurcate, you don't divide, or you don't segregate the actual amount and the tax amount. So when you pay in full to the shopkeeper and all, you don't do the segregation of this or something. So technically speaking, the payables, they are always recorded gross of tax. Purchases, they are always recorded net of tax. Similarly, now those same goods which were bought for $10,000 are now sold for 15,000, excluding tax. Rate of tax is 10%. What will be the double entry? Now, the same goods that you bought for 10,000 earlier are now being basically sold for 15,000, and in this case also the tax is at 10%. How is this going to record in your accounts or something? So the simple entry is going to be if there was no tax, debit receivable with 15,000, credit sales with 15,000, and with tax we are going to debit the receivables with 10%, 1,500. This is 16,500. Credit sales with 15,000. Credit sales tax payable 1500. Now, one more thing. The receivables, like the payables, are always recorded gross of tax, and the sales, like the purchases, are always recorded net of tax. Like purchases, sales are recorded net of tax. Like payables, the receivables are recorded gross of tax. Now, let's just make a T account here for a second. This is going to be difficult, I mean, as far as this word is concerned, but let's just try. Let's just call this our sales tax account. Okay. As far as tax on purchase is concerned, it will come here on the debit side, because in the double entry, this input tax is over here, right? So we have this balance of 1000. Then we have tax on sales. This is at 1500. So the balancing figure is going to be here, and this is 500 that is payable to government. Here we go. I just made up a T account of the sales tax, and we have the input tax on the left side, we have an output tax on the right side, and then we have the balancing figure. And if you look at the balancing figure shows that this 500 is the amount that is eventually payable to the government, because this is our liability net amount. See, we had to receive 1000 from the government, and we had to pay 1500 in the name of the sales tax. So what we are going to do is, from the 1500, the 1000 that we had to receive from the government is the one that we are going to keep in our pocket. And then the above amount 500, that is going to be submitted to the government from our side as a tax payable. Done. That is going to be submitted to the government from our behalf. Done. So this is how it's gonna be done, and this is how basically you are supposed to record. And let me just take you for a second onto our Excel, and let's just make an official account over here. So this is what we are going to call as the tax account. Okay. So sales tax or output tax is recorded here. Purchase tax or input tax is recorded here. Then we are going to have a balancing figure, either here or a balancing figure here, either here. If it is the case over here, if the figure is over here, this is going to be a receivable from the government, and this is payable to the government. That this is how basically the tax account basically works. This is how basically the tax account works. Done. Now, moving ahead from here, talking about within the tax, we have talked about the tax on purchases is the input tax, and if you are registered for the sales tax, that is refundable from the government. And the tax on sales that is the tax on the outputs, that is that is payable to the government, and we have to pay the tax to the government, and that is our liability. Done. Now, moving ahead from there, we have a new concept, and this is something we have seen the basic ones. Some, like, for example, we have seen that now the same goods which were bought for 10,000 now sold for 15,000, excluding taxes written. Now, what if a statement is written as that Mr. A bought goods from Mr. B for 10,000, including tax? The rate of tax is, okay, the rate of tax is 17.5%. The basic standard rate that you can come across as far as your questions of the tax is concerned, right? As far as the basic rate of tax that you're in the papers or in the exam that you can expect to have is the standard rate, and that is going to be at the 17.5%. Now, this is written as that Mr. A bought goods from Mr. B for 10,000, including tax. I mean, if a person comes in and you ask that how much you got this for, and he says, I got this for a total amount of 10,000. So in that 10,000, the tax is already included. So in that 10,000, the tax is already included. And if someone asks that, okay, if Mr. A has bought these goods for 10,000, what should be the double entry to record these? What should be the double entry to record these? How you are going to record? You have to debit the purchase, you have to debit the input tax, and then you have to credit the payable. Now, the question comes in, what should be the amount for purchases? What should be the amount for payables? And what should be the amount for the input tax? Done. Now, we have the information over here that this 10,000 is including tax. So one thing is for sure, that in this 10,000, tax is included. So we are going to credit the payables with 10,000. Now we have to find the figure for the purchase and the input tax. Now, by taking it 17.5% and then deducting off from this amount is not going to help it. Is not going to calculate the actual amount. Okay. This is something now you have to remember, that simply by taking this is, let me show you over here what I'm saying. I have this 10,000. The tax is included into this. Now, so let's just take 17.5% of this. We get what, 1750. Yeah, we get 1750. So 10,000 minus 1750 is 8250. So I can say debit purchases with 8250, debit tax with 1750, and then credit the purchase with 10,000, right? I do it like this, but doing like this is wrong. This is wrong. Why? I have to purchase at 8250, right? So I paid a tax of 17.5% on this 8250. So that is why I have a total amount of 10,000 done. Now 8250 into 17.5 on your calculators, you guys check what do you get. You get 1444, rounding it off. So the total you get is 9694. You can check on your calculator. Debit 8250, debiting the tax to the 1750, we do the credit to the purchase 10,000. For now, the double entry is balanced. There is no issue with that. But when you take the 17.5% of this 8250, you get 1444. The total sum amount is at 9694. The double entry is not balanced. The double entry is not balanced. So, technically speaking, this is wrong. Okay. If this is wrong, then how should we calculate the tax in this situation? The best way to calculate this tax in this situation is to understand a basic equation, you can say. Like, for example, we have the purchases, then we add up the tax, then we get the total amount. Now, we don't know about the purchases, but we know the tax is at 17.5%, and the total amount is 10,000, right? We don't know about the purchases, but we know about the tax, that is at 17.5%. And then we have the total amount at 10,000, right? Now, this is the rule of maths that whose or whatever's percentage is given, let's just, we can assume it to be at 100%. So 100% plus 17.5%, we get 117.5%. So this 10,000, this 10,000 is at 117.5%. So what you're going to do is 10,000 divided by 117.5 multiplied by 100, you are going to get an amount excluding tax. Or if you do 10,000 by 117.5 into 17.5, you are going to get an amount of tax. Now, let's just see it over here. 10,000 by 117.5 multiplied by 100, you get 8511 by rounding off, or 8510 or 8511. And if I do this to this 10,000 by 117.5 into 17.5, you get this at 1489. Now, if I'm right or wrong, let's just see. 8511 multiplied by 17.5%, I get 8511 into 17.5, I get 1489. Total is 8511 plus 1489 is 10,000. So this is the method that you have to follow. So this is the method that you have to follow in order to calculate the amount of tax where the gross amount is given, or where the amount including tax is given to you. So this is the formula that you are going to use, that you are always going to divide it with 117.5, and then you are going to do the multiplication of this with the relevant, either the 100 or the 17.5, depending upon what figure you have to calculate. Done. So the actual or the right double entry is now going to be, the purchases are going to be recorded at 8511, and the tax is going to be recorded at 1489. So this is what the concept of this gross amount is basically. Now let's just see that how much you guys have understood. Let me give you a bit of exercises. This is the total amount, rate of tax. Total amount is 120,000. Then I have 160,000. Then I have 134,568. Then I have 950,000, and then I have 300,000. Rate of tax is 17.5%, 10%, 5%, 9%, 12%. And these total amount including tax. You have to do is you have to calculate amount excluding tax, and then you have to calculate the tax over here as well. Okay, I'm just taking a break of like around 5 minutes. So when I'm back after the break, I need these answers. What should be the amount after the tax, the excluding tax? All of these amounts are including tax, and these are the relevant taxes for these amounts. Okay, so calculate me the amount excluding tax. That what's the amount excluding the tax, and then what is the rate of the tax? Sorry, not the rate of tax. That the amount of tax that will be charged over here. Okay, so this is your short assignment. Hurry up and complete it, and I'll be back after like 4 5 minutes. Let's just take a break on my side only, not to yours. Still, you are done with this. Okay, see you. Okay, so I'm back. So, what are the answers, guys? I've got the answer from Miss Anshuta. Let's just check. Okay. Miss Anshuta, can you explain me your first answer? Miss Anshuta? Miss Anshuta, I'm waiting for your explanation. What about the other ones? Miss Devina and Miss Nabila. Miss Devina, you are right as far as the explanation for the first one is correct. Ale, you are right as well. But Ms. Anshuta, there is some problem in your calculation. So that's why I'm asking that how you have calculated these amounts. Calculations are correct. And who else is left? Okay, Ms. Nabila, what's your answer? Can you guys hear me?
Yes, for the first one, for 120, I got for amount exclusive of tax is 102, 128.
What for the first one? What did you get?
102, 102,128.
Okay. And what's the amount of tax?
17,872.
Okay, fine. Your calculations are correct. Your calculations are correct as well. Now I'm waiting for Miss Anshuta. Please kindly tell me about your calculations. I mean, you have calculated it wrongly. Now I just have to make sure that why you have calculated wrongly. So tell me about your calculations, how you have done the calculations. Because this is 120,000. Okay, I got that. You basically straight away took the amount of tax and then you have deducted it. So this is what I was kind of telling you before, that as far as these amounts are concerned, these are including tax. So you cannot take a straight percentage and then calculate it. You cannot take a straight percentage and then calculate it. You have to like divide them with 117.5. That is the amount of tax in the first one. And then you have to multiply it with the 100 and then 17.5 in order to get the amount of the tax and the actual amount, the excluding tax as well. just show you one or two over here. This is 120,000. Let me show you 120,000 by 117.5 multiplied by 100. This is what you had to do over here, basically. So you will get this 102 128. Done. So this is how you are supposed to calculate the amount excluding tax. For this 160,000, you had to divide it with 1110 multiplied by 100. You will have the amount. For this 134,568, you had to divide it with 105 and then with 100. For this 950,000, this will be divided by 109 into 100, and then this 300,000 will be divided with 112 into 100, and then same kind of things will go as far as for the calculation of the tax is concerned. Done. I hope now it's clear to you guys. Okay, moving ahead from here. Now we have discussed that what is the amount of the tax is, how the amount of tax is calculated, where the amount is including tax, how it is calculated, where the amount is excluding tax as well. And then we have also talked about how an amount is calculated that is either receivable or payable to the tax authorities in relation to the tax. Now, moving ahead from here, okay, I have Miss Davina is over here with us, right? Yeah, Miss Davina, I've got your answers. I mean, I got your answer in the chat box. It's okay, it's perfectly fine. I got your answers in the chat box. Okay, so now moving ahead from here, now let's just have a bit of a practice for our tax. Let me just share a document with you. Rather, let me just open a file. Let me open some questions and then we'll have a practice from those so that we have a clearer picture of what we are doing. Let me just share. This is the stuff that you already have. This is the discounts and the sales tax. This is the chapter 5. Maybe this is the one that I have to share it with you guys, and I will do it. I mean, with you guys, and we'll see to this. And let's just skip the theory for now, and let's just go to the practice questions for now. Okay, so these are the practice questions that we have over here, and these are for the tax, value added tax, VAT, or the sales tax. These are like, one and the same thing. And these are the interchangeable words that are being used. And as far as if we talk about the UK, they have the VAT over there, which we have the name as the sales tax. So the practice questions one, I mean, the first question is basically if an invoice states, but rather let me just copy the questions from here. And let's just have a bit of a practice. Okay. So the first question is basically that if an invoice states that the settlement terms are net 30 days, this means that I mean, if there is an invoice and it is written on the invoice that the settlement terms are net 30 days, what does it mean? It means that the invoice amount, gross of VAT or gross of tax, is payable 30 days from the invoice date. From the invoice date. This is going to be your answer. Because in accounting, we have two approaches towards the recording in the accounts is concerned. One is on the basis of the receipt of the goods, and one is on the basis of the receipt of the invoice. And 99% what we do now is basically we record the transaction in our books when an invoice is either raised or invoice is either received. Done. So if the terms are written as the net 30 days, it means that the payment is to be done gross of tax including tax 30 days from the invoice date. So this is the first thing that we have to keep in our mind. Now it says a VAT registered business sell goods 1200 net of VAT and purchase goods costing 200 gross of VAT. How much VAT is payable or due from HMRC? HMRC is Her Majesty Revenue and Customs. This is the tax authority being in used into the UK. But as we are talking about the international stream and all, so we don't have to talk about, or we don't have to get into the UK thingy. But again, the supply information is good. I mean, you should have an idea about the authority of the tax in the UK. And if you talk about the exams, the way you are going to get the questions, basically you are going to have that what amount is payable to the tax authority or receivable to the tax authority. So this is how one question can be looked at, or this is how you can have a question. Let's just copy this question, and we have the Excel with us as well. So let's just go to the Excel and let's just copy the question over here. And okay. Okay, there's some pasting error. Let me just fix the pasting error. Okay. Here we go. A VAT registered business sell goods 1200 net of VAT and purchase good costing 200 gross of VAT. How much VAT is due or payable to the HMRC? Now, as far as the sales are concerned, they are 1200 net of tax. And then we have the purchases. They are 200 gross of tax. Now, if the rate of tax is not given to you within the question, if the rate of tax is not given to you within the question, so what you are going to do is you are going to assume a standard rate, and that is 17.5%. Now, as far as tax on sales is concerned, you are simply going to 1200 into 17.5%. You get 210 as your tax on sales. And then tax on purchase, this is 200 into 17.5 by 117.5. Then because this is gross amount, na? So you have to calculate it on the basis of the gross amount of tax. So this is going to be calculated as 200 by 117.5 into 17.5. You get 30. So this 30 is receivable. This is payable. So a net amount is going to be 210 minus 30, that is 180, that is payable to the government. So if we go back to the question, this is VAT payable 180. This is going to be the answer. Now, question number 3. If sales including VAT amounted to 27612.5 and purchase excluding VAT amounted to 18,000, the balance of the VAT account, assuming all items are subject to VAT at 17.5%, would be. Now, let's have this question and let's just go back to our Excel. Okay, so this is the sales including VAT is at 27612.5. This is question 2. This is going to be question 3. Okay. So we have sales including tax, and this is 27612.5. 27612.5. And then we have purchases excluding tax at 18,000, right? Tax rate is 17.5%. Now, this is 27612.5 is including tax, right? So we are going to have tax on sales, that is 27612.5 into 17.5 by 117.5, and then tax on purchase is equal to 18,000 into 17.5%. So the first one is 27612.5 into 17.5 by 117.5. I get 4113. And then 18,000 into 17.5, rather I would write 0.175. I get 4113 is payable, 3150 is receivable. If I make up an account for the tax or the sales tax, I can say this is tax on sales. This is 4113. This is tax on purchase. This is 3150. So technically, I am going to have a balancing figure here That is 4113 minus 3150. So 963 is what I have. That is going to be called as a payable, or the balance of this is going to be called as a credit balance. This is a credit balance, or this is the balance that will be eventually paid to the tax authorities. Done. I hope it's clear to you guys. Okay, guys, tell me, do you guys have the exam kit with you right now? Do you have the exam kits?
No.
You don't have the exam kits? Okay. Give me a second. Let me just check. Otherwise, I'll be sending you the exam kits right now so that we can do the practice from. Yeah, be the PPP one. Yeah, Mr. Anshutra. Anshruta. Yeah, the BPP one. Do you have it? Okay, I have the exam kit, but I'm not finding the option to send from here. Let me just share it onto the WhatsApp group. You, all of you are into the WhatsApp, right? Every one of you is in the WhatsApp group. Am I right?
Yes.
Okay. I am sending the exam kit into the WhatsApp group because I don't know why, but I usually had this option to choose from the hard drive, but I'm not finding because the options here are Dropbox, Microsoft One Office, Google Drive, then we have the box and Microsoft SharePoint. I don't know, but why am I not having this option with me to share from this side? Anyhow, this is Financial Accounting December, and book F3, and this is the revision kit. Oh, this is for 115 MB. Okay, that is for more than 100 MB. I'll have to share it with you after the class. Let me just go back to the Excel and I'll just copy paste the questions basically. I'll just copy paste the questions for you guys so that we can do it at least from here. Okay. Why is it not showing? Are you able to see the picture in the Excel file? Because I'm looking at the background. Basically, the picture is not being shown here. Are you able to see it, or you are able to only see the blank screen? Okay. I'm looking at the blank screen as well. So that is why I was kind of wondering what's wrong with this. Why is it not copying? Just give me a minute and let me just try to figure it out what's wrong. Just give me a minute only. Okay, I've tried and tested, but this is the problem with the explicitly the financial accounting exam kit. I mean, I tried with my other exam kits and they are working well. And I'm able to copy paste the image from the exam kit to the Excel file. But for that, this financial accounting exam kit, I'm trying to copy and paste it, but it's not happening for now. So I guess this is something we will have to deal it in the current. I mean, somehow, someway we have to deal with this. So in order to get over it, this is my exam kit. I hope you guys are able to see it for now. And these are the questions related to the sales kit, and I will be asking the guy at the academy to upload this exam kit onto the portal so that you guys have it for the coming classes and all. So question 5.1 is related to the sales tax, and the question is W is registered for sales tax. The managing director has asked four staff in the accounts department why the output tax for the last quarter does not equal 20% of sales. 20% is the rate of tax, right? Which one of the following four replies she received was not correct? Now, W is registered for sales tax, and the managing director has asked that why the output tax, that is the sales tax, is not equal to 20% of the sales revenue. Technically speaking, if the rate of the tax is 20% and the sales are recorded net of tax, then technically speaking, the sales tax has to be equal to the 20% of the sales value, right? So now it's asking that why is it not equal to the 20%? I mean, this is the logical question. Which one of the four following replies she received was not correct? One, the company had some exports that were not liable to sales tax. Now, the company had some exports that were not liable to sales tax. Uh, Technically speaking, if the company had some exports that were not liable to sales tax, then technically speaking, this is going to create a difference of the sales tax and the sales revenue. I mean, our sales tax will not equal to the 20% of the sales revenue. I mean, this option is correct because this can be the case, right? This can be the case because of which our the answer is going to change. Getting my point? Basically, the requirement of the question that is which one of the following four replies she received was not correct. It means which reply is the one because of which there will be no difference between the sales tax being charged and the sales revenue. I mean, technically speaking, in normal terms, whatever sales we have, if we take the 20% of it, should be equal to our sales tax, right? I mean, in normal circumstances. But now the MD in the question has asked that why is it not the same? So the first option that we read is the reason because of which it's not the same. So technically, for the sake of the correct answer of the MCQ, we have to find a statement in which there will be no difference whatsoever between the tax charge and the amount of the sales and the sales tax. They have to be same, right? So the first point, that if we are exporting some items that are not liable for the tax or something, then obviously the difference can be created. There can be a difference because of the fact that our sales tax, our exports are not liable for the tax, so technically speaking we have recorded the sales but we have not recorded tax, so a difference can be there. So this is not the relevant option. Number two, the company made some sales of zero rated products. Now, the company made some sales of zero rated products. Zero rated products are the products on which we pay the input tax, but we do not need to charge the output tax. And the zero rated products are the one on which the tax is charged at a zero rate, at a 0%, right? Zero rated supplies or zero rated products are the one on which the sales tax is charged at 0%. Done. And third one, the company made some sales of exempt products. Talking about the exempt products, they are again the one on which we do not charge the sales tax. Now, the exempt products are the one that are made specifically for the benefit of the humanity. For example, life-saving drugs, for example, wheelchairs, sticks, or some hearing aid equipment or something. These are the ones basically on which the tax is not charged. Then we have some zero rated products. Talking about those, in zero rated products we can have an example of a wheelchair. If you have seen a wheelchair, we have seen that it uses the tires and the rims as well. Those tires and rims can be used in a bicycle as well, or the ladder, basically, in between in between the wheelchair. That ladder basically can be used at some other product or some other thing as well, right? But once those things are combined, a wheelchair is formed. So wheelchair is basically a zero rated product because on which we do not have to charge some output tax. Done. And talking about this, the company sold some product to businesses not registered for sales tax. The company made some sales, uh, or some sales to businesses not registered for the tax or something. Now, if we are selling the goods to businesses who are not registered for sales tax, we are selling the goods to businesses who are not registered for the sales tax. They are not going to have any impact whatsoever on our sales or our tax, because if we are registered for tax, we will be deducting their tax. We will be deducting their tax. So, technically speaking, point number four, if we say, even if we sell it to some businesses who are not registered for some tax purposes or something, it is not going to have any impact whatsoever on our sales or our sales tax. It doesn't create a difference between the tax and the sales, right? So this cannot be option four. So option three are the ones which can create a difference between the sales and the tax amount. But the fourth one, it cannot have a difference or it cannot make an impact on our sales and our tax. Then we have question 5.2. It says the following information relates to EVA's company's sales tax for the month of March 2023. We have sales including sales tax at 109,250. We have purchased net of sales tax at 64,000. Sales tax is charged at a flat rate of 15%. EVA company's sales tax account showed an opening credit balance of 4540 at the beginning of the month and a closing debit balance of 2720 at the end of the month. What was the total sales tax paid to the regulatory authorities during the month of March 20x3? For this, I have to take you to the Excel. And if you look at the Excel, let's just have this sheet 3 for our T accounts and all. So this is going to be sales tax count. I have the balance over here. Now, there's a possibility that we can have an opening balance on this side. There's a possibility we can have an opening balance on this side as well. Similarly goes for the closing balance as well. We can have the closing balance on any side as well. Sales tax is here, the tax on sales, the purchase taxes here. If the cash has been paid, it's going to be here. If the cash refund has been received, it's going to be here. Then we can have either a balancing figure here or a balancing figure here. This is payable, this is refundable. Now, this is the clear and the complete maximum picture of a tax account that we can have. Then, now on the basis of this, we will be solving this question, which is given to us. This is sales tax account, and let's just see what question we had over there. Let me just take you back to the question. Now look here. We have the sales including tax. So let me write this information over there while you have the question with you. We have sales including tax at 109,250. Purchase excluding tax is 64,000. Opening balance 4540. Closing debit balance of 2720. Find cash paid. Here we go. So I have this information with me now. Sales including tax. So the sales tax is here. So we have to calculate this figure, and the sales tax is at flat 15%. So this 109,250 is the amount of sales including tax. So we are going to divide it with 115 and we are going to multiply it with 15 because we have to calculate the amount of tax. So we are going to have 14,250 as the sales tax. Then we have the purchase tax. This is going to be 64,000 into 0.15. So we have 9,600 as our tax on purchases. Then we have an opening balance of credit balance of 4540. And then we have a closing debit balance of 2720. So closing debit balance is always on this side, 2720. And now we have to find the cash paid as the balancing figure. So this is going to be 2720 plus 14,250 plus 4540 minus 9,600. We get 11910 as our answer, because this is going to be our cash paid figure. Done. I hope it's clear to you. Let's just see what's the answer over there. Okay, so this is the fill in the blank. So technically speaking, our answer is going to be 11910 in this case, and this is an option to be filled. So we'll just simply write 11910. Okay. 5.3. Alana is not registered for sales tax purposes. She has registered before sales tax, which is leaved at 15,000. Manager in respect of the invoice. Now we have to record that what is the amount that she got in her letter. Okay, I'm sorry, I got disconnected. Okay, in 5.3, basically, it's straight away telling us that Elena is not registered for sales tax. Elena, this person is not registered for sales tax purposes. Therefore, if technically Elena is not registered or something, what does it mean? It means that she cannot claim the input tax. She cannot claim the tax on her purchases. Simple, right? Getting my point? She cannot claim this tax, nah? Because she's not registered for the tax. And then, technically speaking, when we read about the tax, I told you guys that if you are not registered for the tax purposes of something, then it means that you cannot charge, or sorry, you cannot claim the input tax. How the double entry is going to be over here? That is going to be debit purchase and credit payables with 575, because you are not registered for your tax purposes, but eventually you have to pay the tax. You have to pay the tax even if you are not registered for the tax purposes and all. No? You will have to pay the tax. All right, getting my point? So this is what you have to do. So we are going to debit the purchase with 575 and credit the payables with 575. Done. And now we have another question, and that is information relating to Lauren Company's transaction for the month of the May 2024 is shown below. Sales, including sales tax at 140,000, purchases, net of sales tax at 65,000. Okay. Now, sales tax is charged at a flat 20%, at a flat rate of 20%. Laurel Company sales tax account had a zero balance at the beginning of the month and at the end of the month. There is no opening or closing balance. Now, as far as the sales are concerned, it says Lauren Company sales for the month of 140,000 included 20,000 of sales exempt from sales tax. It says that it has 20,000 of sales which are excluded from the for the tax purposes. So technically speaking, what do we have to do? While calculating the tax on these sales, we have to exclude the 20,000 on which the sales tax is exempt, right? Now the question is, what was the total sales tax paid to the regulatory authorities at the end of the May 2024 to the nearest thousand? We have to calculate that what is the amount of the tax that will be paid to the tax authorities. So for this, let's just go to our Excel. I'm not kind of like, enjoying doing the questions like this. I mean, like, you guys still do not have the exam kit, and then the questions are not being copied over here. I don't know why. If there is some, what do you say, as copyright lock something, or is there on the exam kit or something, because of which I'm unable to. But this is something I will be fixing after the class. So the sales tax is gonna be here, and purchase tax will be here. So total sales are 140,000, including tax, and purchases are 65,000, excluding tax. Done. This is net of tax, and in this, including 20,000 exempt from tax. We have this 20,000 which are exempt from tax, and we have to calculate that what is the tax paid to the tax authorities. So technically 120,000 divided by 120 into 20. Why 120? Because our rate of tax is 20%, and these are including tax. Huh? So by 20 into 20, we are going to have the sales tax. Here we go at 20,000. Then on purchases, 65,000 into, we have a percentage of 0.2. So we have 13,000, that is the tax on purchases. So cash paid as balancing figure is going to be 20,000 minus 13,000 at 7,000, option A. Done. I hope it's clear to you guys. Okay. Now, we have another question over here, and that is, a business commenced with the capital in cash of 1,000, inventory costing 800, plus sales tax is purchased on credit, and half is sold for 1,000 plus sales tax. The customer paying in cash at once. The rate of sales tax is 20%. What would be, what would the accounting equation be after these transactions show? Now, technically speaking, we have to adjust our accounting equation, and we have to tell that what our accounting equation is going to be after these transactions. What's the best way to solve this question is to start off making the accounting equation and then incorporate whatever the stuff you come across, basically. So for this, let's just go to our Excel. Okay, we have this question that is 5.5. Okay, so we have assets is equal to capital plus liability. So the first one is a business commenced with capital and cash of 1,000. So cash 1,000 is equal to capital plus liability. Capital standing at 1,000. This is the first one. Now, inventory costing 800 plus sales tax is purchased on credit, and the customer paying cash at once. We bought the inventory costing 800 plus sales tax, and the rate of tax is at 20%. So we have inventory 800. We have tax refundable here, and then we have a cash balance over here, and the rate of tax is 20%. Nah? So 800 into 0.2, I get 160, and the remaining cash is 40, is equal to capital 1000 plus liability 0. So 800 plus 160 plus 40, this is 1000. Now it says, and half is sold for 1000 plus sales tax. Now you have sold half inventory, remaining is 400, tax refundable is 160, cash over here is 40 plus half is sold for 1000 plus sales tax. So 1000 with 20%, we get this at 1200, right? Because we have received the amount of the tax as well. Huh? So 200 is added into the cash as well, is equal to capital 1000 plus 400's inventory sold for 1000. So how much profit did you make? The inventory with a value of 400 is sold for 1000 because 12 incremental 200 is the tax value. So 400 to 1000, you have a profit of 600 plus a liability on tax of 200. Done. Now the accounting question. This is tax refundable. This is tax payable. So we have to net these two with each other. We are going to have inventory 400, cash 1240 is equal to capital 1600 plus liability, that is 200 minus 160 at 40. So 1640 is equal to 1640. Now assets are equal to 1240 plus 400. 1640 is equal to 1640. Now we have to find this option in our equation. So we have the assets at 1640, and this is nowhere to be seen as far as the options are concerned. Okay. Capital is at 1600. Okay, let me just take you back to the Excel. We have one thing which we can do. Over here, we have this tax refundable and tax payable. Nah? We netted off these two. If we don't net off these two, we have this option then with us. This is assets is equal to 400 plus 160 plus 1240. 1800 of assets is equal to 1600 and 200. Okay, we have this option. Let's just see this option. Assets 1800 less liabilities 200 equals capital 1600. So technically option A, technically option A, no, assets are at 1800, not, wait, where's my 1800? Yeah, assets 1800 is equal to capital 1600 less liabilities 200. So assets minus liabilities equals capital of 1600. We have option A with us. What would the accounting equation after these transactions show? Yeah. Done? I hope it's clear to you guys. Done? Okay. Okay. So we have this option over here with you. Okay, so we are approaching the end of the class time as well. Actually, I was hoping to do one more topic today, but again, due to the break, and then I had to take a 5 minutes break, and then afterwards, the time which we consumed as far as the copy pasting was concerned into the Excel, it kind of ate up our time by like around at least 15 minutes or so. I was planning to do another topic today as well, but anyhow, it won't be done today, but we will try to cover it up for the next time. Okay, the things which you have to do as your homework today or this week is basically to go through whatever the discounts and this sales tax thingy we had. And as far as this sales tax is concerned, you can have a question or one or two into your final exams. But again, apart from having the question to the exam or not, the sales tax is really very going to help you as far as the basic understanding again of the T accounts and all is concerned. So it will help you over there as far as understanding of the T accounts and all is concerned, and it will help you a lot. And as far as doing the practice is concerned, if you guys get your hand onto your exam kits is concerned, try to do a question or two from the sales text topic, and I will make sure that by maximum tomorrow morning you guys have your exam kits and your books with you as well. I mean, I have already sent them from the day one, and I don't know, you guys never had those. I mean, you guys, you do have the notes with you, right? The sets which I sent you, you have those with you as well. I mean, obviously, you guys do have, because of which you have solved your two homeworks, right? So technically, you have those. So you were supposed to get the books and the exam kit by that time. I mean, I sent them all together. I don't know why. I mean, the link was not shared, but anyhow, I'll make sure that you guys have that in the morning so that you have the book and the exam kit with you as well. So till we meet again, it's bye bye from my side. Take very good care of yourself, your family, your friends, the people around you. And till we meet again, I'm available on the WhatsApp as well. If you happen to come across any question or something, you can ask me freely over there, and I'll be more than happy to assist you over there. So take very good care of yourself. Enjoy the long week ahead of you as well, and have a lovely time with your family and friends. And try to study a bit as well. So till we meet again. Bye bye. Thank you.